Welcome to the deep dive. Today, we're taking you right inside PNC Financial Services Group's third quarter 2025 results.
Yeah, we've got the earnings call materials, the press release, everything pulled together.
Our goal here is, well, to really cut through the noise. We want to give you the key takeaways, what drove their revenue, their big strategic moves.
And maybe most importantly, how PNC sees the economy shaping up for the rest of this year and into 2026. That context is crucial.
Absolutely. And the headlines, they look pretty strong. Record total revenue for the quarter.
Right, and net income hit $1.8 billion. That's 4.35 per share, diluted. Pretty solid.
They're also talking up their cost control, got that efficiency ratio down to 59%.
But the really big news, the thing everyone's talking about, is that agreement to buy First Bank. That's a major move.
Yeah, that tells you a lot about where they're headed, maybe even more than the Q3 numbers themselves.
Okay, so let's start with that top line. Record revenue, $5.915 billion. That's up 4% from the last quarter.
So, nice jump. Where did that mainly come from? Was it lending fees or both?
It was definitely both. They saw strength across the board, really.
Yeah.
Net interest income, that's the core earnings from loans, is up 3%.
Okay, 3% II growth to $3.648 billion. And the drivers there.
Well, they mentioned fixed-rate assets repricing higher, which makes sense. Plus, decent loan growth and just having one extra day in the quarter helped too.
Right, the calendar effect. But here's where it gets interesting, the net interest margin, the N.
Exactly.
Yeah.
You'd expect that to be strong, maybe even up, right, with higher rates and loan growth.
Yeah, but it actually dipped slightly, only 1 basis point down to 2.79%, but still down.
It did, and they pointed directly at deposit costs. Specifically, average commercial deposits grew by 5%.
So bringing in those commercial deposits cost them just enough to nudge the overall margin down a tiny bit.
Precisely. It just shows how competitive it is out there for funding, even for a giant like PNC. They had to pay up, essentially.
Okay, so a little pressure on the interest income side, relatively speaking. That makes the other side, the fee income, even more important this quarter.
And that's where the real story is, I think. Fee income, non-GAAP, jumped 9% from last quarter, hit $2.1 billion. That diversification is really paying off.
9% is a big leap. What specific areas drove that?
Capital markets and advisory revenue was, well, frankly, explosive, up 35% quarter over quarter.
35%. Wow. So lots of M&A deals getting done, underwriting.
Seems like it. They specifically called out increased M&A advisory activity, higher underwriting fees, and more loan syndication revenue. Q3 was clearly a busy time for their corporate clients.
Okay, so the investment banking side was firing on all cylinders. What about other fee areas?
Residential and commercial mortgage revenue also had a really strong quarter. That was up 26%.
26%? Driven by what? Servicing rights?
Yeah, higher mortgage servicing rights valuation. Plus, they mentioned increased residential mortgage production revenue. Yep. So both sides of the mortgage business contributed.
Got it. Any noise in the other fee lines we should be aware of?
Well, yeah, and the other non-interest income line came in at $198 million. There was a $35 million negative hit from a Visa derivative adjustment.
Okay.
But that was partly offset by higher private equity revenue. So, always moving parts under the surface.
So strong fees, a bit of margin pressure from deposits. Let's talk about efficiency. They flagged that 59% efficiency ratio, down from 60%. Is that genuinely good cost control?
I'd say so, yeah. Especially when you consider they're still investing in tech and obviously now integrating acquisitions. Getting leaner while doing that is pretty good execution.
And did that translate to bottom line operating performance before thinking about credit losses, the PPNR?
It did. Pre-tax, pre-provision earnings, or PPNR, which measures that core operating leverage, was up a strong 8% compared to last quarter. Reached about $2.45 billion.
8% PPNR growth. So revenue definitely grew faster than costs. That's what you want to see.
Exactly. It shows good operating leverage.
Okay, let's shift to the balance sheet itself. Loans.
Average loans were up slightly, about 1% from the previous quarter, landing at $325.9 billion. But the real action is under the hood, in the mix.
Right, the different types of loans. What changed there?
Well, commercial and industrial loans, C&I, they were the growth engine, up 2% in the quarter and actually up 7% compared to a year ago.
So businesses are still borrowing for operations, expansion?
Seems like it. That looks pretty healthy. But then you look at commercial real estate, CRE.
Yeah, what happened there? I imagine that's where the caution is.
Very much so. CRE loans decreased 3% in just the quarter and year over year. down a pretty sharp 13%.
13% drop year over year. That's a significant pullback. Are they just de-risking that office exposure everyone's worried about?
It certainly looks like a very intentional move to reduce exposure there.
Mm.
Given the uncertainty, especially around office properties, pulling back 13% in a year is, yeah, a deliberate de-risking.
Okay, makes sense. And on the other side of the balance sheet deposits, you mentioned commercial deposits drove growth earlier.
Right. Total average deposits increased 2% to $431.8 billion.
Yeah.
And yeah, that was almost entirely driven by commercial deposits, which jumped 5%.
And consumer deposits.
Stable, basically flat. So the growth and the slight margin pressure we talked about really came from chasing those commercial funds.
Understood. And finally, capital. How are they looking on that front?
Rock solid, really. Their estimated Basel III CET1 ratio tick up 10 basis points to 10.6%.
Okay.
And tangible book value per share, which shareholders watch closely, had a nice 4% increase in the quarter, up to $107.84.
And they returned capital, too.
They did. About $1 billion returned to shareholders in Q3, $700 million in dividends, and $300 million through share buybacks.
Okay, let's dig into credit quality now, because with that CRE pullback, you want to see how the overall book is performing. The headline numbers look pretty good.
Yeah, surprisingly strong, actually. That net loan charge-off ratio actually went down. It was 0.22% annualized compared to 0.25% last quarter.
So fewer loans actually going bad than expected. And the provision, what they set aside for future losses.
That decreased significantly, too, down 34% from last quarter to $167 million.
Wow, down by a third. Why such a big drop?
They specifically mentioned improved expectations for the commercial real estate portfolio within their corporate and institutional banking segment. So maybe some stabilization there, or perhaps the pullback is helping.
Interesting. And delinquencies, loans that are late but not yet charged off.
Also down, dropped 5% compared to the prior quarter. So overall, the credit picture presented in Q3 looks quite healthy on the surface.
Okay, healthy overall. But we keep coming back to CRE, particularly office. Even if they're shrinking the portfolio, what does the remaining exposure look like? Did they give details on the problem areas?
They did provide some specifics, and yeah, this is where you need to focus. The total office CRE loan balance is $5.4 billion.
$5.4 billion. Okay. And the riskiest part of that?
That would be the multi-tenant office loans. That makes up just over half the office portfolio, about 54%. And the metrics for that specific slice are, well, they're stressed.
How stressed?
The criticized ratio is 57.7%, meaning over half those loans are showing some signs of weakness.
Okay, more than half are flagged. What about non-performing? Actually defaulted?
For that multi-tenant office slice, the non-performing loan ratio, NPL ratio, is 19.6%.
Wow. Nearly 20% non-performing within that specific multi-tenant office segment. That's a high number.
It is. It definitely grabs your attention. Even if the overall CRE portfolio is shrinking and performing okay in aggregate, that specific pocket carries significant risk.
So how are they managing that? Just shrinking the total pot?
That seems to be the primary strategy, yeah. Shrink the overall exposure, manage the troubled assets intensely. But that 19.6% NPL figure highlights why they and the whole industry are so cautious about office CRE right now. It's a known concentrated risk.
Right. So that backdrop of generally strong credit, but with this acute CRE risk point, really sets the stage for their big strategic move, the First Bank acquisition.
Exactly. This is PNC playing offense. That deal, implied value around $4.1 billion, expected to close early next year.
Yeah.
It's all about accelerating growth.
And accelerating where specifically?
Key strategic markets, particularly out west. They mentioned Colorado and Arizona specifically. This isn't just adding a few branches. It's about establishing a real, significant presence.
What kind of scale are we talking about?
Well, in Colorado, it more than triples their network up to 120 branches. And in Arizona, it boosts them to over 70 branches. They're aiming for a meaningful footprint in these faster-growing states.
Makes sense strategically, but all this happens against their view of the economy. What's PNC's internal forecast look like? You said it was cautious.
Yeah, their baseline forecast is for slower growth ahead. They see the U.S. economy expanding but slowing down in 2025 and 2026 compared to this year.
Slower growth. Okay, how slow?
They're projecting real GDP growth to fall below 2% in both 25 and 26. And they expect unemployment to tick up, peaking above 4.5% sometime in mid-2026.
So definitely not forecasting a boom, more of a soft landing maybe, but with rising unemployment?
Sort of, yeah. And that feeds directly into their interest rate outlook, which is really interesting given the NIM discussion we had.
Okay, what are they predicting for the Fed? Rate cuts?
Yes. Their baseline assumes 3 straight 25 basis point cuts from the Fed,
Ah.
starting basically right after the new year at the next 3 FOMC meetings,
3 quick cuts. Where would that leave the Fed funds rate?
landing in a target range of 3.25% to 3.50% by late January 2026.
Okay. Did they hedge that prediction at all?
Oh yeah, definitely. They mentioned the two-sided risk. If inflation picks back up, maybe fewer cuts or none. If we hit a real recession, maybe the cuts are much deeper and faster, but their base case is those 3 cuts.
Got it. So slower growth, rising unemployment, and Fed cuts expected soon. How does that translate into their own guidance for the next quarter, Q4 2025?
It suggests a bit of a slowdown heading into year-end. Total revenue guidance is stable to down 1% compared to Q3.
Okay, flat to slightly down revenue. What about NII?
Interestingly, they expect net interest income to be up slightly, maybe 1.5% compared to Q3. So maybe those fixed asset repricing benefits are still coming through, outweighing the initial impact of lower rates, perhaps.
But fee income, the star of Q3, is expected to cool off.
Yeah, guidance there is for fee income to be down about 3% from Q3's strong level. Maybe that M&A boom slows down, or just seasonality.
And crucially, what about credit losses? Charge-offs?
They expect those to tick up.
Hmm.
Guidance for net charge-offs in Q4 is $200 million to $225 million. That's up from the $179 million they saw in Q3.
So they are budgeting for credit to normalize or worsen slightly, which aligns perfectly with their forecast of slower GDP and higher unemployment.
Exactly. They're anticipating some increase in defaults as the economy cools. Hashtag tag outro.
Okay, so wrapping this all up for you. PNC delivered a record Q3, really powered by that surge in fee income, and they made a bold strategic move with the First Bank deal to drive future growth.
Right, but all this is happening against their own internal forecast, which is, frankly, pretty cautious. They see slower growth, higher unemployment, and importantly, expect the Fed to start cutting rates fairly quickly early next year.
And that brings us back to that NIM pressure. It was tiny in Q3, driven by paying up for commercial deposits.
Yeah, but think about this. If their forecast is right, and the Fed does cut rates 3 times in quick succession, that whole funding dynamic could flip, right?
Oh, so?
Well, today, the cost of deposits is squeezing margins. But if rates fall fast, does that deposit base remain stable? Or do depositors start moving money around looking for yield again? Especially with PNC trying to integrate First Bank and manage this bigger national footprint.
Ah, so the very rate cuts they're forecasting could introduce a different kind of volatility, potentially making it harder to manage funding costs and integrate the acquisition smoothly.
It's definitely something to think about. Could that rapid easing, if it happens, actually destabilize things for regional banks more broadly, creating unexpected pressures even for a strong player like PNC as they digest this big deal? That's the provocative thought for you to consider.